there's a photograph I can't stop thinking about. October 24th, 1929. Outside the New York Stock Exchange, men in suits, hats tilted back, faces frozen somewhere between confusion and terror. Some are staring up at the building like it just betrayed them. Others are staring at nothing at all. In 6 hours, $14 billion vanished. That's more than the entire economy of Canada at the time. Gone, not stolen, not burned, just erased. But here's what haunts me about that photograph. Those men had no idea what was coming next. They thought this was the bottom. It wasn't even close. My name's Woof, and I've spent way too much time studying financial disasters. Not because I enjoy watching people suffer, but because the patterns repeat. Different decade, different technology, same structure. And the Great Depression, that wasn't just bad luck or mass hysteria. It was engineered, not intentionally, but systematically, by a man newspapers called Sunshine Charlie. His real name was Charles Mitchell, head of National City Bank, the most powerful banker in America, confident, charismatic, optimistic to a fault. And in March of 1929, when the first cracks appeared in the market, he made a decision that would doom millions. He removed fear. To understand what Mitchell did, you need to understand what America felt like in 1929. Electric. Radios in every home, cars on every street, skyscrapers climbing higher, consumer credit exploding. The Dow Jones had risen sixfold in 8 years. Everyone was getting rich. Clerks, teachers, taxi drivers. People who'd never owned a stock in their lives were suddenly investors. But here's the thing nobody talks about, like they weren't investing their own money. They were borrowing it. It was called buying on margin. And it worked like this. You could buy $1,000 worth of stock with just $100 of your own cash. The other $900 borrowed from your broker. If the stock went up 10%, you doubled your money. If it fell 10%, you were wiped out. And by 1929, everyone was doing it. Margin debt had exploded to levels never seen before. The entire market was built on borrowed optimism. And optimism, when it's leveraged, becomes fragile. March 1929. The market wobbles. Nothing dramatic, just a dip, a hesitation. But investors who'd borrowed heavily started to sweat. Brokers started asking questions, and fear, real fear, started creeping into the room. That's when Charles Mitchell stepped in. He held a press conference and announced that National City Bank would inject $25 million into the market to support confidence. It worked. Stocks stabilized, prices climbed again. Newspapers called him a hero. But what Mitchell actually did was far more dangerous. He taught the market that fear would always be rescued, that dips would always be bought, that there was no such thing as too much debt, because someone would always step in. Here's what most people don't understand about crashes. They don't happen because prices fall. They happen because debts must be repaid. Let me show you how it works. October 24th, 1929. The market opens, heavy selling begins. Investors who'd borrowed to buy stocks watch prices slip. Brokers issue margin calls demanding more cash to cover the loans. But most investors don't have more cash. So brokers do the only thing they can. They sell the stocks automatically, which pushes prices lower, which triggers more margin calls, which forces more selling. This is the cascade, not panic. Mechanics. Leverage turns a decline into a death spiral. On Black Thursday, 13 million shares changed hands. Phone lines jammed. Orders couldn't get through. Brokers screamed across the floor because the wires had gone silent. And in the middle of it all, Charles Mitchell tried the same trick again. He and a group of bankers publicly bought blue-chip stocks to signal confidence. For a few hours, it worked. But you can't stop an avalanche by standing in front of it. Black Thursday was just the beginning. October 28th, Black Monday, the market plunges again. October 29th, Black Tuesday, 16 million shares traded in chaos. Prices collapsed, fortunes evaporated. But here's the part that matters. The crash was violent. The depression was structural. Because what happened next is what turned panic into a decade of suffering. Banks had lent billions into speculation. When the market crashed, those loans defaulted. Then depositors got nervous. If your bank looked weak, you rushed to withdraw your cash. And when enough people did that, even healthy banks failed. Between 1930 and 1933, 9,000 American banks collapsed. 9,000. Each failure wiped out life savings. Families lost everything overnight. Businesses lost credit. Investment froze. And here's the kicker. The government didn't insure deposits back then. If your bank failed, your money was just gone. Let me tell you about one man. His name was William. William was a school teacher in Ohio, 43 years old, saved for 20 years, had $4,200 in his local bank. Not rich, but comfortable. In 1931, his bank failed. He lost everything. No warning, no recourse. Just a sign on the door that said closed. William never recovered. He died in 1936, broke and broken. Multiply that story by millions, and that's the Great Depression. But it gets worse. In 1929, America was on the gold standard. That meant the money supply was tied to gold reserves. When banks failed and loans contracted, the money supply shrank. And when money disappears during a crisis, deflation sets in. Prices fell, wages fell. Businesses failed because consumers stopped spending. By 1933, unemployment hit 25%. 1 in 4 workers had no job. Industrial production fell by half. Global trade collapsed after countries threw up tariffs to protect themselves. This wasn't a recession. It was a contraction of the entire financial system. And it started with one man telling the market that fear was unnecessary. So was Charles Mitchell the villain? Honestly, I don't think so. He wasn't malicious. He genuinely believed confidence could prevent collapse. But confidence without fundamentals is like building a skyscraper on sand. And the 1920s were all sand. Corporations created investment trusts, early mutual funds, that used leverage to buy other leveraged trusts. Layers upon layers. Profits looked spectacular on the way up. Nobody asked what would happen if prices stopped rising, because they never had. This is the pattern I keep seeing. When asset prices rise long enough, memory shortens. Risk feels theoretical. Debt feels normal. In 1929, Americans believed they'd entered a permanent era of prosperity. In 1933, bread lines stretched across cities. The Great Depression lasted a decade. It reshaped America forever. Regulation wasn't ideological, it was survival. An attempt to prevent leverage-driven collapse from happening again. But here's what keeps me up at night. We learned the lesson. We built the safeguards. And then, slowly, we forgot. Glass-Steagall was repealed in 1999. Leverage limits were relaxed. And in 2008, 79 years after Black Thursday, the system broke again. Different assets, different names, same structure. Debt amplifying optimism until optimism cracks. Here's what the Great Depression teaches. Markets don't collapse because prices fall. They collapse because debts must be repaid. If 1929 had been funded with cash, the crash would have hurt. Because it was funded with borrowed money, it became catastrophic. Leverage converts volatility into systemic risk. And optimism is most dangerous when it becomes consensus. Charles Mitchell didn't cause the Great Depression alone, but he stood at the peak of a fragile system and mistook stabilization for strength. When he reassured markets in March 1929, he didn't prevent the crash. He delayed it, and delay in a leveraged system makes the eventual collapse worse. Because more debt piles up. History doesn't repeat perfectly, but structure repeats. And when I look at that photograph from October 24th, 1929, I don't just see men who lost money. I see men who believed the system was solid, right up until the moment it wasn't. Debt is invisible when times are good. It becomes visible all at once when times are bad. And when it does, the unwind is never gentle. That's the lesson. Not from 1929, from every crash before it, and every crash that's coming.